Good morning, everybody. Hope the week is treating you extremely well. An extremely busy week. We had a ton of major companies report earnings this week, and probably the busiest earnings week of earnings season. Still more to come Thursday after the bell and on Friday. We also had the Fed rate decision Wednesday afternoon. They decided to keep the rates unchanged and also remove some verbiage in regards to some rate hikes. So pretty dovish out of the Fed. And that actually sent the dollar down, markets higher, and sent the emerging markets actually to a breakout level. Emerging markets closing over the 200-day moving average for the first time in 9 months. I'm going to get into the emerging markets chart here in just a second. But before we get there, don't forget also Friday before the bell, we have non-farm payrolls. A lot of the government data, we were not getting the full picture here during the shutdown of the last months. So really eyes on that data. And so there's still a lot more important information to come out here this week. Also in this video, after we're done discussing the emerging markets, we're also going to take a look at the feed and greed index and discuss what that could mean sentiment-wise for us when we take a look back at some of the previous numbers. So first and foremost, let's pull this up right here. The emerging markets, as we can see, closing up over its 200-day moving average yesterday, and days below the 200-day moving average, 184 days in a row under that 200-day moving average, and that has a major impact when we get a break above after such a long time below. Sentiment Trader ran these numbers. As we can see, 1 week later after we spent more than 3 months underneath that 200-day moving average, if we look at the 1987 to 2019, 1 week later, it's positive 70% of the time. 2 weeks later, 64% of the time. But where it really starts looking good is a month and further out, almost positive 93% of the time. And your risk to reward is what's very, very attractive here. Average down draw would be 0.5%, average move higher 5%. When we go out a year later, right, the large down draw 7.6%, but the upside 17.2%. So those numbers actually do look pretty good once you get back over that 200-day moving average. Of course, the key is going to be, can it hold over it? When we look at this chart, we talked just technicals. We've been mentioning the emerging markets look very strong as a potential breakout candidate because we had that bullish divergence. We put in higher lows when the rest of the market was putting in lower lows at the end of December. The emerging markets held their ground and actually put in a higher low and finally made that break over that false breakout that was put in early in December, broke the year-long downtrend and is up over its 10, its 20, and its 50-day moving average. All of those are pointed up. The 200-day moving average, of course, is still sloped down. So continue to keep your eyes peeled for opportunities abroad. The emerging markets, if it can hold over that 200-day moving average, it does bode well historically over the next 6 months to a year. Now, one of the things I really like to pay attention to is sentiment data, because we always kind of want to be able to see what the crowd is doing and where they are positioned, because oftentimes the crowds are wrong at the turning points. Right? Everybody's kind of loaded up short when the market's about to rebound. Everybody's loaded up on the long side when the market typically tends to be nearing a pullback. In the middle, the crowd is right. So with the main move of the trend, the crowd is correct. But it's at the turning point that we need to pay very, very close attention. So I know a lot of people talk about different fear and greed models. You see that posted all over different financial sites. What they used for this data was the CNN fear and greed model. And we can see that we went from, during that sharp sell-off there in December, we went to extreme fear, almost a reading of 0, the lowest reading that we've had, all the way down here. And essentially, there's nowhere else for it to go. Fear is essentially as heightened as it can possibly be. And then when we get that reversal, right, there is a lot of potential move to the upside when we're that oversold, so to speak. And what we look for is that, that move back up towards that greed reading, and that's where we're at right now. So we went all the way from complete fear to greed in a very, very short period of time. That's not something that typically happens, and the main point to pay attention to is that we're still under that 200-day moving average. Now, when we look at that in depth and take a look at the numbers, as we can see right here, a couple of months out, it's actually very, very negative. This is some of the most negatively skewed data that we've taken a look at. You go 2 months out, it's only positive 13% of the time, with the average drawdown of 5% and an average upside of 2.8%. You go 3 months out, average down draw of 11 against 4% to the upside. 6 months out, average down draw of 20, upside of 3. So, I mean, those numbers are really, really bad. And if you think about it, they make logical sense. You go from extreme fear to extreme optimism in such a short period of time under that major technical level, that 200-day moving average that we're paying attention to for longer term moves. We go from way too much fear, way too much optimism, and then usually that will subsequently end up as a potential move back to the downside. There's not a ton of instances of that. There's only 10 occurrences, so the data set is pretty small, but it does lead to reason that after such a violent move to the downside, such a violent move to the upside, if we can't clear that 200-day moving average, that major long-term trend line, if we can't get up above that, that would lead to some concern for that potential rollover. And I know a lot of people are looking for a double bottom, that test from back in December. So in today's video, we took a look at the emerging markets that have gotten up over their 200-day moving average and actually look poised to make a move to the upside. Then we took a look at the sentiment on the S&P 500, and we see some causes for concern simply for the fact that we're underneath that 200-day moving average. Bottom line, what we're paying attention to, and what's very, very important, is can we get up over that 200-day moving average? And we're taking a look at the S&P 500. For me, it's not just the 200-day moving average. We really need to clear that 2820 zone. If we get up above that, I think it's all hands to the upside. We're definitely going to get that follow-through push. But we're still, as good as things looked, as good as the earnings have looked, as good as this season's looked, as dovish as that Fed has gotten here, we still have technical issues on the chart. And until we get back above that, we still need to have that kind of cautious mindset. So until next week, guys, I hope you guys found this video useful. I will